Have you ever wondered why some investors seem to be hunting for hidden bargains while others are, chasing the next big thing? Or maybe you're just trying to make sense of the whole finance world, wondering, is there a path that fits me? Well, today we're doing a deep dive into the main types of investment strategies. Think of them like different roads investors take. Our mission here is to unpack these core approaches: value, growth, passive, and dividend investing, using insights from our sources.
Yeah, and understanding these it's really like getting a map for this complex finance world. It helps you decode why people invest the way they do, the different philosophies behind it all.
Okay, let's start that first route then. Value investing. My first thought goes to just buying cheap stocks. But the sources hint it's more involved, finding something truly undervalued. How does that actually work? How do they find that?
That's a really key distinction. Yeah, value investing isn't just about cheapness. It's about finding solid companies that the market has, temporarily gotten wrong or just overlooked. When we talk about intrinsic worth, our sources show it's less about the daily ups and downs of the price and much more about what the company's real assets, its earning power, its long-term cash flow truly suggest it's worth. Often means going against the cloud, looking past the noise to the fundamental business.
Right, so it's less about a quick win and more about a deep belief in the company's actual underlying value. Yeah, that's a big difference. So if value investing is like being a careful art detective finding a hidden gem, then growth investing feels more like trying to spot the next giant wave before it even forms. Is that a fair way to put it?
That's a great analogy, actually, yes. Growth investing is conversely all about companies with huge future potential, big expansion, big earnings growth ahead. You're really investing in what you believe they will become, betting on that upward path, that innovation. Think about maybe a tech startup that's set to shake up an entire industry. The focus isn't maybe on profits today, but on explosive growth down the line, market share, revenue, that sort of thing.
Okay, shifting gears a bit now. Away from picking individual stocks, passive investing. It seems like it's really surged in popularity, hasn't it? For listeners maybe wanting a more hands-off approach, what's the core idea there?
Absolutely, it's become huge. Passive investing is generally a long-term strategy. It usually involves holding broadly diversified index funds, or ETFs. The goal isn't really to beat the market, like with value or growth maybe. It's more about matching the market's overall performance over time. You just track a broad index like the S&P 500. And as our sources highlight, this gives you great diversification and often significantly lower fees compared to funds where managers are actively picking stocks. It appeals to people who think, look, consistently beating the market is just really, really hard.
Makes sense. Okay, and then the last one, dividend investing. For people who like the sound of getting regular payments, what's the special appeal there beyond just hoping the stock price goes up?
Right. Dividend investing specifically targets stocks from companies that regularly pay out a portion of their profits to shareholders. Those are the dividends. So it provides this steady income stream. You're essentially getting paid just for holding the stock. But, and this is important, you still have the potential for the stock price itself to go up over time. That's the capital growth part. So you potentially get both the regular cash and the stock appreciation if the company does well. So pulling it all together, whether you're drawn to finding those bargains or betting on future giants or maybe just riding the market wave passively or seeking that steady income, each strategy really offers a distinct approach, a different way to navigate. And crucially, there isn't one single right way. It really depends on your own goals, how comfortable you are with risk, that sort of thing. And knowing about these core strategies, it helps you make sense of market news, Understand why different investors act differently. It even gives you a framework, a really valuable one, for thinking about your own financial situation and what kind of investor you might lean towards being.
So, yeah, lots to think about there based on everything we've just unpacked today. Which of these investment approaches, value, growth, passive, dividend, which one do you feel might align most closely with how you think about money? Or maybe what new questions does this deep dive spark for your own financial journey? Something to consider.